Imagine opening a crypto wallet and seeing something that looks like a SpaceX share. Not a meme coin with a rocket logo, but a token that claims to represent real stock. That is the question behind SPCX on Solana. Is it actually a share, a crypto token, a receipt, or just another risky wrapper with a familiar name? In June 2026, reports describe SpaceX going public on NASDAQ under the ticker SPCX, while a tokenized version of that stock also appeared on Solana through Backpack Securities and Sunrise. The timing made it hard to ignore. A very famous company hit public markets, and almost immediately, crypto users saw a version of that exposure moving through wallets and DeFi rails. But the important part is not the SpaceX brand alone. The bigger story is how tokenized securities try to connect three worlds that normally do not move together very smoothly. One world is the traditional stock market, where legal ownership, brokers, clearing systems, and investor rules matter. Another is the custody layer that holds assets. The third is the blockchain, where tokens can move. A share-backed token is supposed to work like a digital claim linked to a real share held somewhere off-chain. The token moves on-chain, but the actual stock still lives in the traditional system. That difference is everything. If you own a regular crypto token, the blockchain can usually show the whole supply and transfer history. With tokenized stock, the most important backing sits outside the chain. Think of the token like a warehouse receipt. The receipt can be passed around quickly, but its value depends on whether the warehouse actually holds the item it promises. For SPCX, the reported claim was that each token was backed one-to-one by a real SpaceX share and could be redeemed through the connected brokerage process by eligible users. One-to-one sounds simple, but it does not mean the blockchain magically contains a share. It means the issuer says there is a matching share held through regulated financial infrastructure. The issuer is the bridge operator. It decides how tokens are minted, who can redeem them, what checks are required, and how the on-chain supply stays linked to off-chain shares. In a clean version of the process, a real share is obtained or held by the brokerage system first. Then, a corresponding token can be minted on Solana and sent to a user wallet. Redemption goes the other way. The user sends back or burns the token, and the system credits or transfers the related stock through a brokerage account, if that user qualifies. That last phrase matters. If that user qualifies. Securities rules are not optional just because the token is on a public chain. Location, identity checks, and account status can all matter. This is one of the strange parts of tokenized securities. The token may move on a public network, but the legal rights around it may still depend on private contracts and regulated accounts. So why use Solana at all? The appeal is speed, low transaction costs, wallet access, and the existing DeFi environment, where assets can trade outside normal market hours. If this kind of practical crypto breakdown helps, consider subscribing. We focus on what the system actually does, where the risk sits, and what beginners should check before trusting a token. Traditional stock markets open and close. A token on Solana can be transferred at any time the chain is running. That can feel powerful, but it also creates new timing problems. If the token trades on a weekend or late at night, the underlying stock market may be closed. The token price can drift because traders are guessing where the share will trade next. For a tokenized stock, price tracking is a constant challenge. The token should stay close to the share, but fees, liquidity, redemption limits, and market stress can create a gap. When redemption works well, traders can help close that gap. If the token is too expensive, they may create more. If it is too cheap, they may redeem or buy it. But that loop depends on access. If only some users can redeem, or if redemptions pause, then the token can trade more like a separate market than a perfect mirror. Liquidity is another key word. A headline can say millions in volume, but beginners should still ask how deep the order books are and how much price moves on larger trades. Volume tells you how much traded over a period. Depth tells you how much can trade near the current price. Those are related, but they are not the same thing. Crypto people also talk about composability. That means one on-chain asset can be plugged into other applications, like decentralized exchanges, lending markets, portfolio tools, or automated strategies. Composability can make markets more flexible. It can also stack risk. If a tokenized stock enters a lending app, then custody risk, smart contract risk, and market risk can combine. On-chain, you can see token transfers, wallet balances, contract addresses, and trading activity on decentralized venues. That transparency is useful, but it is not the full ownership picture. Off-chain, there may be the actual share, the custodian, brokerage records, legal agreements, identity checks, and redemption procedures. Those pieces may matter more than the token animation. If you hold the token in your own wallet, you may control the private keys for moving that token, but that does not automatically mean you control the underlying share directly. This is the beginner trap. A token can represent a claim, entitlement, or wrapper, but the exact legal ownership depends on the product documents and the jurisdiction behind it. Two tokens can both say tokenized stock and still be very different. One may be share-backed and redeemable. Another may be synthetic exposure. Another may be a fake ticker with no backing. A share-backed token tries to connect each token to a real share or security entitlement. The key questions are who holds a share, who audits the backing, and who can redeem. A synthetic token is different. It may track the price using collateral, derivatives, or an oracle. It can provide exposure, but it may not give any claim on the actual stock. A fake token is simpler and more dangerous. Someone copies a ticker, creates a contract, adds a logo, and hopes people buy before checking the official source. SPCX is especially confusing because the stock ticker and token ticker can look similar in headlines. A ticker alone is never proof that a token is official, backed, or redeemable. For any on-chain asset, the contract address matters more than the name. Scammers rely on people searching a ticker and clicking the first token that appears. A beginner should start from the issuer or brokerage website, not from a random chart, chat post, or search results. Then compare the contract address and product details carefully. Next, look for redemption rules. Ask whether the token can become a real brokerage position, what fees apply, what minimums exist, and whether redemption can be paused. Also check who is allowed to use it. Some products may exclude certain countries, require full identity verification, or only support redemption through specific accounts. Then check custody. If the product says shares are held in custody, ask who the custodian is, what role the broker plays, and whether backing reports are available. If the token depends on an oracle or reference price, ask where that price comes from. Bad or delayed pricing can cause trades, liquidations, or app displays to behave strangely. Smart contracts add another layer. Bugs, admin keys, upgrade controls, or permission settings can affect transfers and market behavior. A real-world asset can still have on-chain code risk. Tokenized securities often need controls that ordinary crypto tokens may not have. Transfers might be restricted, tokens might be frozen, and addresses might be blocked for compliance reasons. That sounds less crypto-native, but it is the trade-off. If the product is connected to regulated securities, it may need rules that limit the open transferability people expect from crypto. So what does SPCX potentially solve? It can make a public stock easier to move into on-chain markets, easier to hold in a wallet interface, and easier to combine with crypto tools. What does it not solve? It does not remove securities law, eliminate custody dependence, guarantee liquidity, or prove that every token using the same ticker is legitimate. People care now because tokenized real-world assets have moved from whiteboard talk to live products. Treasury bills, funds, private credit, and now high-profile equities are being tested on public chains. Reports around the launch said tokenized equity trading on Solana saw a major jump, with SPCX driving a large share of activity. That does not prove success, but it shows demand to test the rails. The real test is not one exciting day. It is whether minting, redemption, pricing, custody, compliance, and user support continue working when markets are boring, volatile, or stressed. A good mental model is simple. The token is the fast-moving wrapper. The share is the regulated asset. The issuer and custodian are the bridge. The documents define the real rights. Before trusting any tokenized stock, ask 4 questions. What backs it? Who holds the backing? Who can redeem it? What happens if the issuer, app, or blockchain has a problem? The biggest misunderstanding is thinking tokenized means risk-free modernization. Tokenization changes how an asset moves and connects to apps. It does not erase the risks around the asset itself. SPCX is interesting because it makes the future of market infrastructure feel concrete. It is not just a theory anymore. But interesting does not mean simple, safe, or suitable for everyone. If you remember one thing, remember this. With tokenized securities, the blockchain shows the token, but the real question is always what legal and custodial system stands behind it. What part of tokenized stocks still feels unclear to you? Ask your question in the comments, or suggest the next crypto topic you want explained in plain English.